Hi, I'm happy to take you through the October version of the Alpha Strategist, which is titled The Perfect Storm. Our broader equity markets had already started correcting from February, March. However, the Nifty kept climbing and hitting all-time highs, and this was on the back of a few stocks rallying. Nifty also gave way in the month of September. The month of September was quite brutal for the small and mid-cap indices. This was set in motion by many factors. First, the dollar rate started going up after Fed indicated that they will resort to more hikes and faster hikes. The one-year treasury bill rate went up from 1.3 to 2.3% over the last 1 year. The 10-year hit closer to 3.3%. This saw outflows from across emerging markets, and India was no exception. We've seen close to 50,000 crores of outflows from Indian debt markets and close to 15,000 crore outflows from Indian equity markets. On the back of these developments, oil also rallied to closer to $85, putting further pressure on our current account deficit, and as a result, currency depreciated close to 14-15%. Finally, we saw a default from one of our premier financial institutions, which came at a very tough time. Typically, end of September is very bad for money markets because of advanced tax outflows and half-yearly closing. So, with ILFS defaulting on some of its obligations, it set off a scare that this may become a contagion and a lot of other NBFCs may follow. Fortunately, what has happened is that the government and RBI have isolated the ILFS as an institution. They have changed the board, and there is a resolution process which is underway. Our view is that the resolution may take a few months, as there are several approvals that they will have to seek before asset sales can be done or some liquidity can be provided. The shareholders have agreed to infuse some liquidity which will give immediate relief. However, as a result, what has happened is yields have gone up, and that has impacted debt funds. Few portfolios have had ILFS which have taken a knock, and we have reached out to all of you to update you on your portfolios as to what we feel and what you should be doing going forward. In equities, like I said, the small and mid-cap indices corrected very sharply. Mid-cap index is corrected about 27% from the peak. Small cap is corrected close to 40% from the peak. Whereas large cap is down about 11%. So a lot of portfolios will look pretty bad if you evaluate them right now. Our view is that till currency stabilizes, and which is also a function of oil prices stabilizing, volatility will persist. Further, we are going into an election year. You have state elections around the corner, followed by general elections. So volatility could continue to be high. But more importantly, what should you be doing on your portfolios? There are one of three situations that you will be in today. The first is where you still are underweight equities and you're still in the process of building your equity exposure. I think this has come as a boon. We believe you should build your exposure over the next 6 to 8 months in a staggered manner. Continue to stick with high quality managers across different styles, and put more money whenever there are deep cuts in markets. Second, you're fully allocated and you have a good equity, debt or asset allocation mix. Our view is that you should stay invested and go through this phase. This is a temporary period of volatility which needs to be seen off. Things will change, tide will turn. We'll continue to review our portfolio. However, the whole idea is not to take any irrational decision based on immediate movements in markets. At the same time, I think this is also a good time to revisit your risk profile. If you had too much pain in the portfolio and you've not been able to stomach it, it basically means that you have more risk in your portfolio than you can tolerate. I think it's a good idea to sit down with the relationship manager and revisit the risk profile and see if you need to lighten your equity exposure to a level which keeps you calm. Third, you may have more equities, as equities would have done well over the last 3-4 years in your portfolio. This is the time to cut equity exposure and bring it down to neutral levels. So I think it's important that you have an investment charter and a strong asset allocation framework in place, because I strongly believe it's only discipline and long-term focus which can help you bide these times of volatility. We've seen it in the past as well, and whenever these periods have happened and these kind of cuts have happened in markets, in hindsight, it always turns out to be a decent investment opportunities. We've sent out a note where we've done this analysis. Whenever the markets is corrected 10% or more, if you had put money at that point in time, the 3-year returns have looked pretty decent. So we'll continue to talk to you, engage with you, and update you on any further developments. So thank you very much for being with us.